We're going to do a break-even EBIT calculation right now. And the simplest way to do it is to just go through an example, and it'll show what we're trying to calculate. Now, the first thing is, what is break-even EBIT? We talked about it before. That's the level of income at which it is profitable to add debt. So just like in my house example, if the house was losing money, you wouldn't add debt. If it's making money, you would. But it's not so simple as if you're making $1, you add debt. There's other things to consider, like interest costs and taxes. So that number is higher than zero, but it needs to have a certain level of profitability. So here's a scenario where the company has $20,000 in equity and no debt. They have 400 shares outstanding in this scenario. They can add $8,000 of debt with a cost of 8%, use the money to repurchase shares. So they're not increasing the value, they're just refinancing the company. There's no taxes. What's the break-even EBIT for the company? Now, the break-even EBIT occurs when the earnings per share is the same for both scenarios. Okay, so which scenarios am I talking about? The debt scenario versus the no debt scenario. Okay, so the earnings per share is going to be the same. And remember that earnings per share is net income divided by number of shares outstanding. Now we can simplify that. What is net income? Net income is equal to EBIT, earnings before interest and taxes, minus interest times 1 minus the tax rate divided by the number of shares. So in this case, we're going to get an earnings per share, we're going to get a break-even EBIT when the earnings per share is the same for both of those two scenarios. So let's do the earnings per share with no debt. That's the one we were given first. So it will be EBIT minus interest times 1 minus the tax rate divided by number of shares. So interest is going to be 0 because there's no debt. Tax rate is given as 0. Number of shares was given as 400. And EBIT is the variable. So that's what we're trying to solve. So this essentially can be reduced to EBIT over 400. Now, what's the earnings per share of the scenario with debt? So let's write the same thing out again. EBIT minus interest times 1 minus the tax rate over number of shares. So what is tax rate is still 0. Interest is going to be $8,000 of debt that we added times 8%. Okay, so it's going to be 640. Now, number of shares. How do we get that? We are going to look at, what did we start with? We started with 400 shares minus the amount that we bought back. And how much did we buy back? So we spent $8,000 to buy back the shares, but we don't know the share price. Let's scroll back up and find out. Can we figure out the share price? This is the value of the company before everything started. And this was the number of shares. So we can conclude that the price is equal to the value of the company divided by number of shares. Okay, so it is equal to 20,000 divided by 400. So it's $50 per share. So if we plug that in, How much did we buy back? We bought $8,000 worth of shares divided by $50 per share. So we bought back 160 shares. Therefore, the shares outstanding are 400 minus 160, which is 240. Okay, so I'll just put this as our final answer there. And then if I simplify that with what we plugged in, I get EBIT minus 640 divided by 240. Okay, so our break-even EBIT will occur when those two are the same. And our break-even EBIT will be, so here's the first one. That's with the EBIT with, or the earnings per share with no debt. And then here's the second one, the earnings per share with debt. So if I plug that in and make the two equal, I will get the following. EBIT over 400 has to equal EBIT minus 640 over 240. And then if we cross multiply and solve for that, essentially I will come up with an EBIT, break-even EBIT of $1,600. Okay, so if I was to put that on a timeline, or not a timeline, but like a profitability line, we know that it's a number greater than zero. 1,600 is our break-even EBIT. So what that means is anything to the right of that, it makes sense that adding debt will increase the return on equity of a company. So if your EBIT is above that, anything to the left of that, it'll do the opposite. Adding debt will decrease return on equity. Okay, so it's a useful concept to know. In reality, most companies won't add debt right at the break-even EBIT. They wait for some buffer line, but this tells you the bare minimum of income you should have before you consider it.